I want to introduce Ruben Gonzalez, who, and I'm going to read this because it's impressive. Ruben Gonzalez is a chief economist at Keller Williams Realty International, KWRI, the world's largest real estate franchise agent count. In this role, he provides strategic economic analysis and market insights to guide Keller Williams agents, leaders, and clients through the ever-changing real estate landscape. His expertise helps agents understand national housing trends, mortgage rate movements, and a broader economic shifts that impact both buyers and sellers. Gonzalez frequently shares his insights through Keller Williams platforms, including the KW blog and Outfront magazine, offering detailed market update and forecasts. With a background in economics and a passion for real estate, Ruben plays a pivotal role in helping Keller Williams professionals navigate market complexities and make informed decisions, including our founder, Gary Keller. He literally sits with him for hours, and I know you'll talk a little bit about that, Ruben. And it was funny, Ruben, so I posted your graphic that you're going to be with us today, Keller Williams Valentine. By the way, the number 2 right now, I believe, in profit share and owner profit in the entire company. Woo! I had to say that. Whoop, whoop. And people said, I know, clap for that. And people said, how did you get Ruben? I said, I just asked. So thank you so much for being here. He's an extremely busy man. He's also going to have one of his economic analysts on with him. Isaiah will be here as well. So we're going to let Ruben take over, and at the end we're going to open it up for questions. So as you're listening to things that Ruben's sharing today, please write notes because he loves Q&A. All right? Well, Ruben, welcome to Keller Williams Valentine. Let's give him a huge round of applause.
Hopefully I can live up to that glowing introduction. First, I want to say Charlotte's an awesome city. I've been to Charlotte many times. My significant other's parents live not too far from Valentine, actually, over in the Sardis Woods area. So I've been to Valentine a couple times, the Valentine Bowl, hung out at the Mecklenburg Brewery. It's a really cool area. So I'm going to go ahead and share my screen, and we will jump in. I've got national stats and also some, let's see, local stats as well. Presentation mode here. Cool. So hopefully you guys are seeing what I'm seeing and everyone can hear me well. So let's go ahead and jump right in. So on the national level, we're looking at unemployment sitting at about 4.2% next week. Maybe a little bit later this week. I think next week we'll get May numbers. This could trend up a little bit. It's a little bit hard to predict a lot of things right now because of the kind of shifting policy environment. But so far, all signs, for employment in May seem like it probably held relatively steady. We may see that number move around a little bit, but I don't think we'll see any substantial jumps. A lot of the concern right now, this is a theme you'll kind of hear me hitting on as we go through this, is a lot of the concern is forward-looking. So as we kind of navigate a changing policy environment, you'll see there's ongoing things, but the numbers that are out right now, for the most part, still remain fairly strong. So we'll talk a little bit about where the risk is, but know right now the economy still seems to be on stable footing as we stand today. So I went ahead and pulled unemployment for Charlotte and the North Carolina as a whole as well. I did use Tar Heel Blue for North Carolina, you'll see there, and the official Charlotte Green for Charlotte. One thing I noticed is that Charlotte seems to have an interesting cyclical pattern. You'll notice that the unemployment there bounces up and down a lot compared to the North Carolina total, or the dashed black line, which is actually the U.S. level. I'm not actually sure entirely what drives that, especially given that from what I know about Charlotte, a lot of the employment there is driven by the financial industry, some pharmaceuticals, a little bit of, I know there's some manufacturing there as well, so it could be that. It seems like unemployment there tends to peak in the summer. So I don't know, just like an interesting little tidbit. I'm not really sure what's going on, so I may investigate more in the future. But overall, you guys are doing really well. You're trending below the national unemployment level. And Charlotte overall economically seems to be outperforming the rest of the country and the rest of the state. So looking at something that kind of really tells the story for more of what you're kind of hearing in the tenor of the news. Maybe you're talking people looking for jobs right now. The gold line here represents the number of job openings reported in the country. The blue line is the number of unemployed people. We're coming out of a period post-pandemic where you can see that gold line was quite a bit above the blue line, meaning there were a lot more jobs than there were people to fill them. And so there was a bit of a mismatch. You saw a lot of people switching jobs. It was a lot easier for people to get higher salaries, higher wages. We're coming out of that period. These lines are about to cross again into what was kind of more normal. A lot of the leverage is swinging back to the side of employers and away from the side of employees. So you're kind of hearing that from people. They feel a little bit less secure in their jobs, a little bit less confident in their ability to switch jobs or find a new work if they lose their current job. Probably a little less secure, a little less confident going into things like salary negotiations than they were a couple of years ago. And that does impact our industry, right? Because people's confidence in the future definitely impacts kind of their decisions when they're looking at, borrowing large sums of money that they're going to be paying off over the next decade or more. GDP. So last year was a strong year at 2.8. We're projecting a slower year this year in growth at 1.7. Now these projections came out really before a lot of the tariff news started coming out and policy really started shifting. So far, I haven't seen this get meaningfully adjusted down. I suspect, given the first quarter, we may see, when the Fed releases their next set of projections, which should be, I think, next month, but maybe the following meeting, it may move down a little bit. We'll see. There's no one's really super confident how things are going to shake out. So again, uncertainty, forward-looking pessimism is sort of the theme right now. Looking at the first quarter, that decline it's concerning, but there's a catch because what it was actually driven by was essentially a lot of large companies and basically importing a lot of goods. So our imports shot up in the first quarter in anticipation of tariffs as people started trying to increase their inventories and warehouse a lot of things in order to basically avoid paying those tariffs. So, our net exports, the trade deficit, is part of the GDP calculation. Because that shot up so much in that quarter in an unusual way, it really led to that negative movement. Now, if you look at specifically the consumer spending, it's not as strong, I would say, as it's been the last couple of years, but it's still positive. There haven't been any major movements there that are really concerning yet. Again, it's forward-looking. The second half of this year going into next year, that's what's driving a lot of what you're hearing about in the markets right now as we go forward. Again, I pulled GDP for both Charlotte and North Carolina now. At the city level, GDP is reported with a very large lag, so we only have through 2023 for Charlotte, but North Carolina we do have through the end of 2024. So you can kind of see, again, similar story to unemployment where Charlotte's outperforming both the state and the country in terms of growth. And I suspect that did continue through 2024. The reason I think it outperforms a lot of the rest of the state is because there's a lot of essentially economic decline in more rural areas of North Carolina. I'm sure you guys are somewhat familiar with that idea. Over the last couple of decades, it's kind of been an underlying theme. But the Charlotte area in general has remained much stronger. There's a lot of strong employment there, a lot of big employers. So that's continued to grow at a fairly rapid pace. That's, close to, I believe it was around 6% in 2023. I wouldn't be surprised if it was right around there again in 2024. So inflation, the Fed has a stated goal of a 2% target here. Their ability to tolerate inflation above that is going to depend a lot on what else is going on in the economy. As the economy slows down, they are going to be more hesitant to raise rates, but at the same time, right now they're not in a position to lower rates because, again, of the forward-looking concerns we have about inflation, which is related to tariffs. There was also a little bit of slowdown in inflation coming through the year, but overall, when we look at this on a monthly basis, so this is the consumer price index on the gold line, what we call core CPI, which excludes food and energy. The reason we exclude those two things, despite the fact they're very important to most consumers, is simply because they tend to fluctuate a lot very quickly because of things that are, really outside of the control of really the Federal Reserve, a lot of government policy. Think back to when egg prices spiked. A lot of that was driven by avian flu, right? We've seen energy prices spike in the past because of things that happened outside the country. So that's why we separate the two. But if you look at it, they're both still trending in the right direction. We're at 2.8% for the core number and 2.3%. That dip's been driven a lot by the decline in energy prices. Gas is down some, food's down a little bit as well. But overall, this is kind of stabilized around this kind of mid 2% range. So the Fed would like to see this continue to come down. But right now, because of where policy is, take a step back. They had been lowering rates, right? They paused now, despite the fact that this is still trending in the right direction. And that pause is being driven by uncertainty around what's happening in tariff policy. Not necessarily just that the tariffs are going to create inflation, but also the uncertainty of they're having a hard time forecasting the impact tariffs will have because they're moving around so much right now. So until we get to a more stable place, it'll be hard for the Fed to kind of understand where they need to be setting policy as their forecasting models are fluctuating so much. So we should expect to see them kind of dragging their feet a little bit as we kind of go forward for the rest of the year. I think maybe at the Fed level, we may get one more dip in rates, but it's looking increasingly unlikely as policy continues to fluctuate. I will also say, we'll talk about this a little bit when we get to mortgage rates. There's other things right now that are probably that have been the primary driver of why mortgage rates have moved up so much in the last couple of months, and we'll talk about that in a little bit when we get there. Consumer sentiment. So this is at a very low level. Again, this is driven by forward-looking. People's views on the current economy are relatively positive, but when you ask them what things are going to look like 3 to 5 years out from now, it becomes very negative. A lot of that being driven by expectations around inflations and people being quoted on the fear being driven by the tariffs and fluctuating policy around them. There was an initial reading for May. It hasn't been in the chart yet. Jim got the final reading, but it dipped down to about 50, which is really one of the lowest. I believe it's the lowest level historically that we saw there coming out of the pandemic when inflation was, at the highest level we've seen in many years. So risks. We already touched on some of this. So the biggest risk right now to the economy as a whole is, the unpredictable policy we've been experiencing around trade, immigration, regulation, and spending. So government spending contributes to growth. If that declines, that will take away from growth a bit, so it's a risk. Trade, obviously, we've been hearing, the back and forth about tariffs. In general, they're going to be considered contractionary and inflationary as they drive up the price of other goods, particularly in the short to medium term. We're going to have to see how they evolve, where they end up being set. There's a lot of movement. We saw it over the weekend where we talked about a 50% tariff in Europe, and then it got paused until July. And now they're fast-tracking some discussions, so we may get some changes there. But as long as these sort of kind of ad hoc, unexpected policy announcements are happening, we should expect to see this sort of bouncing around volatility in essentially in U.S. Treasuries, which are then translating into higher mortgage rates. So it's driving a lot of volatility right now. As much as we can debate what the long-run impacts may be in the short run, we should expect them to have upward pressure on prices and mortgage rates. As it makes basically very difficult for people to plan, and people are kind of having to try to bake in guesstimates on where their pricing for their products are going to be as they go forward. Looking again now at what triggered was this large dip in the S&P 500. We know this is impacting our industry. We've heard about deals falling apart where, people are using funds that are, maybe have been saved in relatively volatile assets in the industry, or maybe they're using reserve funds for a 401k. So far from the peak that we were at in February in the S&P 500 to where we are more recently, we're still down almost 6%. These things can take, various amounts of time to recover. In the Great Depression, it took 2 decades. After the pandemic, during the pandemic, we had a crash that took a couple of months. This will probably be, right now it seems to be, we may stay at this -5%. There's so much volatility. And especially with the stock market being volatile, I don't want to make predictions. But we have recovered, close to 10 to 15% of, the loss we had. But it still remains below the peak where the market was before. So it's still going to be weighing on people's minds. They're looking at their savings that they have invested. So moving on to real estate, specifically looking at home sales for this year nationally. We were projecting about 4.3 million, which is going to be a small uptick. Now we're looking at maybe 4.2. We haven't adjusted this yet. A lot of the forecasts are coming around 4.25, so it's still kind of rounding up. But looking forward, we're not seeing a lot of upward movement in many markets across the country right now. Charlotte being one as well, where sales are still relatively flat. The good news, and there's some markets as well where they're declining. But again, we've been talking about this for a couple of years. We kind of think we're kind of scraping along the bottom in a sense, just because a lot of the transactions we are seeing are the life reason transactions, moving, having kids, marriage, those kind of things that are going to continue to happen regardless of sentiment or economic conditions for the most part. This should improve, but again, this is another place where the increased volatility continues to weigh, potentially as people kind of want to take a wait and see approach, as it makes planning for the future a little bit more difficult. On a monthly basis, we continue to track below last year. We think as we move into the summer month, we should begin to see year-over-year increases, but with interest rates having now tracked up above 7%, we'll have to see. If they can get below where they were last year, which was about 7%, I think there's room for us to essentially outperform last year's sales during the summer on a national basis. But with mortgage rates as unpredictable as they are, and the fact they're at 7% again now, it could be pretty flat. We could be tracking pretty close to last year, given that we're going to have similar economic conditions and similar mortgage rates going into June that we had in 2024. For prices, we're projecting growth around 2.5% right now for the year. We're seeing prices go backwards in some markets right now. In others, appreciation has largely slowed down. The places where we're seeing the fastest appreciate right now are the Northeast, so New York, New Jersey, Philadelphia. A lot of those areas are seeing double-digit price increases. But in the South, places, I believe Tampa was negative this past month when looked at from the Case-Shiller Index. Austin has had some price decreases as well. A lot of the markets that saw the most rapid price growth during the kind of boom years of the pandemic are now seeing either decreases in prices or the slowest growth. Things have slowed down. And Charlotte's not an exception. Prices there have slowed down quite a decent bit, but they haven't gone negative. And you guys did see, we'll get to a slide in a little bit about a 20% year-over-year increase at one point during that run-up of prices. So on a monthly basis, again, tracking just above last year. This is a good thing that we're not seeing rapid price growth right now, given the pace of home sales. It's increasingly looking like we may get back some affordability through prices. Normally we would expect mortgage rates to be where we get back to, some of that affordability in terms of monthly payments. But there are markets now that are giving it back via price decreases, which will create some opportunity, but also is going to be challenging for some homeowners, especially those that bought at the peak of the market, those that bought in the pandemic years, where, we've seen it in Austin where people are listing houses. They're, close to underwater potentially, especially if they were doing things like flips and they purchased during those time periods. And those houses are just kind of sitting listed at, prices higher than what the market is willing to give right now. So, same conversation we were just having, looking at affordability, it remains elevated, 33%, just above, where P&I peaked back in 2006. Again, I think there are going to be parts of the country where this improves via price decline, and other places where we're going to kind of be playing the waiting game for mortgage rates to come down, which is probably going to take a couple of years at this point. Inventory has been trending up, so it's another part of the story. We've been seeing substantial increases. We've seen quite a few markets that are having 40 and 50% year-over-year increases in the number of listings that are on the market right now. Charlotte's not an exception, is seeing quite a bit of inventory as well. We'll get there. But overall, the number of listings from across the country in most places is trending up. The exception being, again, where those price increases were the Northeast, New Jersey, Philadelphia, New York, some parts of New England. They are seeing inventory increase as well, but it's much slower than the rest of the country. Days on market trending up, but not dramatically. As we hit the summer, they'll hit their seasonal lows, and then trend up into the winter. It'll be interesting. I think Q4, Q3 is going to be interesting to see how high this gets, as we come out of the summer and where inventory is going to be sitting. Because I think it's not impossible we're going to move well above 5 months of supply on a national basis. Maybe see home prices nationally even get close to moving backwards. So Q4 is going to be kind of telling this year kind of where the market's going to be going in terms of the pace of things. Again, we're still at very historically low levels for days on market. 60 days on market is not an unusual number. So we're sitting still at half of that as we stand today. So mortgage rates. We're projecting about 6.3%. That's going to be adjusted up at this point as we head halfway through the year, and we're already back at 7% with recent market movements. As things stand, if we continued kind of where we are now, I think we'll be closer to last year's average, which is about 6.7. I think the probability that we see substantially lower rates than last year is increasingly decreased at this point. That's a weird thing, that increasingly decreased. Increased, or just decreased, I should say. But yeah, with the tariffs, the movements in treasuries, it's going to mean upward movement in mortgage rates. So, talking about what's driving this right now. So, in April, we were at 6.7% on average. Today, we stand at about 7.1%. It's moved down a little bit, I believe, this morning. But treasury rates have been increasing, and that's really what's driving this. So, what's driving the treasury rate? And if you're not familiar, the 10-year treasury rate is a government bond that issued by the U.S. government, largely through history, has been considered the safest place to put your money, or through the history of the last 70 years or so, has been considered basically the safest asset to invest money in, which brings in a lot of foreign money as well as a lot of domestic savings. Our retirement money and things like that are put into U.S. treasuries. We want them to stay safe and not move around very much. The 10-year treasury is the one that typically moves about 1-to-1 with the U.S. mortgage rate. If you think about, the typical 10-year someone has in their house being 7 to 10 years, it tends to line up right, on a mortgage-backed security, most of those assets are going to be earning that rate of return, which is the mortgage rate, for about 7 to 10 years, which is pretty close to what the 10-year treasury is when you look at it. It's easy to think that it should be 30 years because it's a 30-year mortgage, but because people don't tend to stay in their home for the fullest of their mortgage, the 10-year is the one you need to look at. That's been trending up. Tariffs are part of that conversation. So there's interestingly kind of an accounting identity in international finance, without getting too nerdy here, that basically has to do with the fact that the trade deficit is also more or less equal to the amount of foreign investment that moves into a country. So as we do things like increase tariffs to lower the trade deficit, it sort of necessarily means less money is going to be moved into the U.S. from foreign countries, which essentially, a lot of that money goes into things like bonds. So you're kind of necessarily pushing up the rate of return on a treasury by decreasing the demand for it, in a sense. So it's that. There's also, the discussion of like the fiscal situation in the U.S. in terms of the budget bill that has gone through Congress. That obviously also, the timing of that with, we had a credit rating institution downgrade the United States government's credit rating, which felt a little bit like, it was time to align with, that bill as well. So, as the deficit potentially increases in terms of our fiscal deficit, there's just questions right now, I think, internationally about how safe the U.S. is as a place of investment, what kind of returns they can expect. And that's put upward pressure on our treasuries, and that's then translating into higher pressure on mortgage rates and higher rates as, they're kind of competing goods. If I'm a bank, I have a choice. I can invest my funds into U.S. treasuries, which are safe but yield a lower return, or I can buy mortgage-backed securities, which there's a little bit more risk to, but I can charge a premium for, and therefore I can earn a higher return. That's where we get that kind of 2% gap between the two. If you're a finance person, you can dig deep on this and learn about treasury spreads, how those move and things like that. I'm not going to get too far into it, but just understand that, when you're looking at the news and everyone's talking about bond rates, that is what's impacting mortgage rates for your clients right now. So new home construction, so new home starts on a monthly basis have been on a downward trend really since the end of last year. There was the one minor blip, but this last month they fell down to 922,000 starts on an annualized basis. This is being driven by the same thing that's pushing down, ordinary home sales for the most part. Builders are unsure. They're slowing down their investments. They're going to slow down on permitting and starting until they get a little more confidence in like where demand's going and financing. So, speaking of that, the red line here is single family home starts. The blue line is the builder confidence index essentially. And you can see that, the blue line tends to some extent lead the red line, and it's been declining recently, reflecting the kind of negative sentiment amongst builders as they, see, the impact of tariffs on their business, right? As, there are many building materials that are made from foreign material that's part of the country, whether it's gypsum, steel, aluminum, timber. We know that immigration is also, enforcement is also impacting that industry. As, like it or not, they are typically one of the largest employers of undocumented workers in the country. So if that enforcement increases and people are more nervous about showing up to job sites, that's going to drive up their cost of labor and slow down the pace at which they're able to complete projects. Sales. So new home sales on a monthly basis actually increased quite a bit. That's on a bit of an upward trend, normal seasonal pattern, but also, again, despite their negative sentiments about taking on new projects, those that have already completed projects are building out communities. They're looking to get deals closed, and one of the things they have at their disposal that the average real estate agent or home seller does not is a lot of them either work closely with or own their mortgage companies, which allows them to do things like buy points, discount mortgages, as well as offering incentives to buyers in terms of the construction as well, things like appliances. Now, again, some of those may increasingly become expensive for builders as things like the cost of appliances and upgraded appliances increase. But for now, especially in the financing side of that, they're able to offer incentives, which is creating, it's making new home construction increasingly competitive with existing homes because of the financing. So looking at North Carolina specifically, you guys are trending a bit below last year in terms of properties sold. Year to date, again, down about 10%. Median sales price is up, but not very much. You're looking at like maybe 1% here. Median sales price year to date, again, not up very much, about 1%, a little bit more. Inventory, however, is rising. You're looking at about 25% in month supply. Active listings, about 20%, a little bit more. Increase year over year for the whole state. Days on market, down a little bit for April, but had been trending up. I suspect this will pop up. I think there's just kind of some noise in that data. So then we're looking specifically at Charlotte. So interestingly, like a very strong month in March. April slowed down a little bit. I suspect Charlotte will continue to trend above the rest of the state, but maybe a little bit slower than last year as that market, I think trended a little bit up last year compared to the rest of the country, and maybe it's just now starting to see a slowdown many of us saw a little bit sooner. Again, in terms of properties sold, up a bit from last year in total year to date, thanks to that strong April number. Median sales price tracking higher than the rest of the state in terms of the percent change, but still slow from where it had been, sitting at about 2% year over year in April. Again, year to date, looking at about, right under 3%. So this shows the Case-Shiller index for both Charlotte in the green and the US in the dotted line. So you can see over the last, basically since we came out of the pandemic, Charlotte had been tracking above the national price growth speed. So, you guys hit above, that's probably 26, 27% at the peak. Things slowed down substantially, then picked back up again a bit in 24, and now things are kind of trending down more in line again with where things are going nationally. I suspect many markets across the country are going to be seeing growth that's trending below, or price growth that's trending below 4%, and it's increasingly likely that more markets may see negative appreciation this year, meaning decreasing prices, as we see building inventory and we see affordability remain challenging, whereas interest rates sit at 7%. So month supply, things are increasing in Charlotte, but it's still a very competitive market because sales are still relatively strong, sitting at 2.8 months from 2 months last year. So, prices have slowed down, so inventory is increasing, but it's still a relatively competitive market, sitting in a seller's market for the most part, but probably feeling like it's shifting to a buyer's market. 2.8 is still a pretty strong seller's market, but that margin of movement going from 1.8 and even lower before that up to that 2.8 is noticeable, and probably going to be continuing in that direction as we move forward. So active listings, this has moved up quite a lot. So looking at, probably close to 30% here. Days on market also has increased quite a bit. So looking at 54 days on market. And I'm gonna go, I have a couple other cities, if you guys are interested, we can get into that, but I'm actually gonna stop here so we can jump into some Q&A for the next 15 minutes.
Yeah, I love that. Thank you, Ruben. All right, so who's got questions?
Robin, I did. Hey, Ruben, thank you for being here. The big question I have for you is, what is the messaging you feel like we need to get out to our potential clients and customers in this market? Because it does sound like we have some pluses compared to other markets and compared to the national news. So what would that talk track look like that we need to get out to our clients and customers and people that we're approaching to come buy and sell it here in Charlotte?
I think I would definitely highlight the economic strength of the city, right? Like that lower than, average unemployment rate, that GDP growth, you can look into pulling numbers on job growth in the area, how the job growth has been increasing. Charlotte is a economic hub in that area. It's very strong, the financial industry has been doing very well recently. Big banks are doing well. You've got, Lilly there, you've got Honeywell. There's a lot of very large companies based in that area, Lemon Tree's there as well. It's a good city, like it's a strong economic environment, it's continuing to grow. I would show that the, price growth outpaced the rest of the country and outpacing with it, compared to other markets like Austin, where it's actually, prices are declining following that boom. So, it's been a more sustained economic cycle there than what we've seen in other cities that have now gone backwards. I think you could probably highlight population growth as well. I didn't have that here, but that data is out there. And, in terms of the overall economic environment, I think, being a source of information to help them deal with the uncertainty. A lot of people don't understand what's going on necessarily. And we don't have to give them an opinion on what's going on, but we can give them information that they may not have seen elsewhere. We can give them facts. You can show them local information particularly, and just kind of help them deal with the uncertainty. Because I think that's, a challenge right now. Aside from that, it's, finances are a challenge. Having the ability to talk about, mortgages and their options there in a sophisticated way, I think is important right now as well. Hopefully did that answer your question?
Yes, thank you.
Yes, thank you. Who else has a question?
Hey Ruben, quick question. You mentioned earlier in the presentation that you don't see rates coming down substantially for several years at this point. Can you kind of dive into that a little bit deeper?
Yeah, so, we're sitting at 7% now. The thing that needs to happen for those rates to come down is a couple of things. So, I said I wasn't gonna get too nerdy. I'm gonna look more nerdy now. So there is, in the mortgage rate, there's kind of two pieces. The 10-year treasury rate is kind of the foundation it sits on, if you think about it. And then on top of that, you've got the spread, the gap between the mortgage rate and the 10-year treasury, which is kind of this thing that bakes in both, it's a risk premium, a little bit of a term premium. It's sort of the sketchy part between the safety of a 10-year treasury and buying a mortgage-backed security, of that like uncertainty that buyers are going to be able to repay their debt, they're not going to sell their houses or pay their mortgages off too early. When someone buys a house and sells it in 3 or 4 years and closes out that mortgage, that's sort of a loss on mortgage-backed securities books. They much prefer that we all held our mortgages for 30 whole years and just paid out that full amount of interest, right, when they're from an investor standpoint. That premium is slightly elevated right now. It's come down a little bit, but the more safe mortgage-backed securities look in comparison to 10-year treasuries, the more they'll look. Now, that can happen in two ways. People can start feeling better about the housing market, or people can start feeling worse about treasuries. Either one of those will start to close that gap a little bit, right? But right now, the thing that's driving it is the Treasury. As long as this kind of tariff uncertainty persists, there's going to be a little bit of that's going to continue to drive rates up, or at least keep them elevated, I should say. I don't want to say that they're going to go up substantially from where they are now, but it's what's keeping them from coming down. So far, every tariff agreement we have is at most, we're putting them off by 90 days. So there's still another round of discussions and solutions that have to come out of this that we don't know where they're going to settle. And that basically means, at least for the rest of this year, in my opinion, we're probably going to be looking at rates between 6.5% and 7%, unless we get some kind of unforeseen resolution of the situation that essentially investors look on very positively, which could mean a quick decrease in rates. If we do get some solution that essentially Wall Street and foreign investors decided, hey, this is best case scenario, we're back to business, we're not worried about this anymore, we could see a pretty substantial downward movement. So that's sort of like, that is your situation where you see rates come back to where they were at the beginning of this year. And, we kind of start looking at, the Fed being able to drop rates again. That's, if we get some resolution here and people feel good about it in terms of investment, with investing in the US and where trade's gonna go, that's the good scenario. That doesn't seem to me like a super likely scenario right now, which means I expect that we're gonna continue to see policy fluctuation, shifting sentiments around it, which is going to mean rates kind of stay a little bit higher. And the fact that tariffs on their face, are generally considered inflationary, also means the Fed's more concerned now about the future and the path of inflation there, which is also, slowing their ability to lower rates on their end, which, while it's not what's affecting rates the primary way right now, it is an important factor. The fact that they're going to have to take a longer pause than was maybe expected at the beginning of the year will also mean those rates stay elevated. So, it's hard to understand what's going to happen 2-3 years from now, but certainly for the rest of this year, it seems like rates are going to stay a little higher than we initially anticipated. With the context being that kind of the initial forecast was for rates to fall down into the low sixes potentially by the end of the year. We were never predicting, 5% rates this year. But now instead of getting down to the low sixes, we're looking at the upper sixes, which then kind of means, if you just kind of trend that out into 26, we're starting from a higher place, right? So even if they go down, typically they're going to move down relatively slowly. So kind of that whole downward movement we were hoping to see in rates has just been kind of like pushed out a little bit further, with also the caveat of just sort of the uncertainty of, who knows what next year will hold. Did that answer your question?
Yes.
Yes,
Yeah.
thank you. What other question? Anybody else? Another question? All right, so from your perspective, Ruben, what's the biggest opportunity agents have today?
I think the increased inventory is an opportunity in a way. Buyers have had very limited choices for the last several years. I think the increase for the buyers that are out there, I think that's the challenge. I think, talking to the agents I've spoken with, seeing what's happening in the markets, I think that a challenge from an agent perspective right now, from what I see, is kind of the shift from, we are going from a mindset where the listing is sort of the thing that the premium is on, right? You have to go find listings. If you can get the listings, you can do the business. Now it's shifting. You have to go find the buyers, right? So I think for the buyers that are out there that have the finances, that have the cash or that built up equity to make a move right now, there's a lot of choice that they wouldn't have in a different market. I think the fact people have more options, there's more variation on the market, there's more across geographies. I think that's a good thing. I think helping them navigate that choice can be a challenge, because we're probably moving into an environment where it's not going to be unusual to sell or to show more houses than you would like to show. I remember when I got in this business around 2012, and people were really frustrated with having to show people 40, 50, 60 houses before they were making offers and things like that, right? Because there was just a ton of inventory on the market in a lot of places. We're probably not going quite to that extreme yet, but it's going to feel in a lot of places a little bit more like that. Where working with a buyer becomes probably a little bit more tedious. But I think that's where the opportunity lies for me as well, is highlighting that increased choice, that range, finding the gems that are out there. And then for those who are more, challenged, finding the deals. There's going to be stuff sitting on the market as well that I think is going to allow people the opportunity to probably get some stuff with some value already baked in to those transactions, finding stuff that they can get essentially at or below market because of the shift and the fact that maybe they were overpriced to start with. I think that's kind of the environment we're moving to. I think the shift in leverage is moving toward buyers a little bit. I think there's ways that we can take advantage of that, and use that. I think that's the shift. It's shifting from kind of like the seller mentality to the buyer mentality.
Wonderful.
I'm curious, how you guys think about that as well. I'd love to hear from you guys as well, like what you're seeing in your market, if anyone wants to talk about it. If you think I, was off a little bit about something based on my numbers, I'm always open, because sometimes, we see the numbers, we see a high level of view, but maybe we're missing something at the local level that you guys have more insight into than we do. So I'm always excited to hear feedback from agents in the areas that we talk to.
Yeah, well, I think you nailed it. We have kind of a nice little bubble right here in the Charlotte metro area, and I think that overview that you give us, I mean, even talking about Austin and what you're feeling in Austin right now, which really was one of the hottest markets in the country for a very long time, so you're feeling that. So just being able to pay attention to what's going on in the country, because even though we feel a little bit protected here because of what our numbers look like today, we have to be aware of what's going on. Everybody agree with that? Mm-hmm. Yeah. Anyone have any other feedback or comments you want to add? Was this helpful?
Yes.
Yeah. I mean, very few market centers get this opportunity one-on-one. We usually see Ruben only on stage with Gary Keller. That's the only time we get to see you, Ruben. And we are so appreciative of your time today. Can we give him a huge Valentine? Any chance you can get those slides sent to us?
Yes.
Yeah, so I'll have those slide PDFs and sent over to you guys. I also want to say I'll be in North Carolina for the regional summit in October. I do those as well. It's another chance for those of you who are able to attend that. Will get to see me. Mark's a great guy. I've been coming out several years now and presenting with him. And then also I just want to plug, we have the market podcast and videos. You can find them on YouTube or wherever you get your podcast. The Keller Williams Real Estate Market Update is the title. It's a little bit longer than I wanted it to be, but I don't get to do branding.
Yeah, write that down, everybody.
We do about a 30-minute take. We've been doing 10-minute videos for over a year now, but we've kind of shifted into more of a podcast there, so you can actually get a pretty, almost something like what we're here, but we'll dive into only 2 or 3 topics and kind of go deep on them. This next month, I think we're going to talk about, the inventory conditions around the country and how that's shifting. And the first one we did was tariffs. The last month, we talked a little bit about, I think, the Treasury issue and what was going on there. So, it's a good source of information, something you can maybe listen to in traffic.
Wonderful. Well, thank you so much. Have an amazing week. We really appreciate you.
Yeah, thanks for having me.